In this video, I'm going to explain a butterfly spread options trading strategy, step by step, from the perspective of a professional options trader. So, if you're trying to understand how a butterfly options spread works, why it's important, and how it can help you become a better trader, then this is the video for you. Now, if you don't have time to watch the whole video and you'd rather just get our cheat sheet explaining the most important things with butterfly spreads, you can click the button that should pop up on the corner of this video or go to the link I have in the description. My name's Scott Bauer and I've been trading for over 30 years. I'm a former Goldman Sachs VP, and today I'm going to teach you how the real professionals on Wall Street use butterfly spreads to potentially find big profits in the markets. Don't forget to hit that like button nearby and subscribe to our channel if you want to learn more about options trading and our favorite options trading strategies. Let's dive in. Hi there, everybody. All right, today's discussion is going to focus on what is a butterfly, whether it's a put butterfly, call butterfly, how do you set one up, pluses, minuses, and then also how does that differ from something that we trade often called a broken wing butterfly, broken wing put or call butterfly. So let's first dive into a regular butterfly and what a butterfly is. So in a butterfly position, a long butterfly position, what you're really trying to do is almost hit the bullseye, or kind of pin the tail on the donkey, if you will. What do I mean by that? Well, let's take a look at Tesla here for a second. Let's say we're bullish, and a butterfly can be set up with any sort of direction, any sort of bias, bullish, bearish, or even neutral, Okay, so let's say we're bullish and we want to go out here to next week, the April 14th expiration. Okay, so the first thing we're going to do is what we normally do with any sort of setup is we look for what is the expected move. Right? What is the market pricing in an expected move over a certain period of time? So we're going out to the April 14th expiration. So what we're going to look to do here is look at the at-the-money straddle for April 14th. The at-the-money straddle for April 14th, if we look at the 11:35 call and put option here, we come up with roughly $87. Okay, what that tells us is the market is currently pricing in Tesla, a move to this expiration April 14th of plus or minus $87. Okay, we don't know what that move is going to be, but the market is telling us the size of the move with a 68% probability. Pretty good. So with the stock trading 1135, $87 expected move, let's say we're bullish, we're going to target roughly 1220-ish or so. Okay, so why is that? So with the stock 1135 and an expected move to April 14th of roughly $87, we are going to target 1220. So great, we want to target 1220. Well, with every strategy that we trade, everything, every signal that we put out there, the goal for any one of our spread strategies is for the stock to move as close as possible to the short strike at expiration. If that happens, that maximizes our profit potential. So in this case, since 1220 is our target, we know that's the option we want to sell. Okay, now in a butterfly consists of three options. Okay, and again, they can be puts, they could be calls, it could be bullish, it could be bearish. We're going to use call options here since we are bullish. And a regular butterfly is always in a 1 to 2 to 1 ratio. Okay, buying 1, selling 2, buying 1. Also, in a regular butterfly, the distance between the strikes is symmetrical. Okay, what does that mean? What does that mean? Well, let's take a look at Tesla here. Okay, we know that the 1220 is the option we want to sell because that is our target. That's where we hope the stock goes at expiration. So let's create a $20 wide butterfly, and we could create anything we want, $5, $10, $20, $50 if we want. The key is that the strikes are symmetrical, meaning the distance between the first strike and the middle strike is the same as it is between the middle strike and the last strike. Okay, so in this example right here, we are going to create, so we are creating the 1200, 1220, 1240 call butterfly. Okay, the strikes, as you can see here, are symmetrical. So what we are really doing with the 1 to 2 to 1 ratio, okay, when you break this down, and so many people get afraid of the name of a particular option spread, a butterfly, an iron condor, a strangle, a straddle, and think, oh my God, that is too complicated. You know, I can't trade that. You know, I'm too much of a beginner for that. Well, when you break a particular strategy down to just its bare bones basics, okay, and you break a butterfly down to its basics, what you really have are two different spreads. Okay, we have a long 1200, 1220 call spread, and then we have a short 1220, 1240 call spread. Okay, this right here is the equivalent to this 1 to 2 to 1 ratio. Now, why would you ever do that? Why would someone ever do that? Okay, if we think the stock is going to 1220, you can create any sort of call spread you want. Obviously, the wider or the bigger the distance between the long and the short strike, the more expensive that's going to be. In this case, what we're doing right here, okay, what we're doing right here is we have two vertical spreads, a long spread and a short spread. We are selling the 1220, 1240 to help finance the purchase of the 1200, 1220, with, again, the goal being that the stock moves to that middle strike, which is the strike we identified as where that expected move is. So let's look at the pricing on something like this. Okay, if we were to price this out, we can see that the midpoint of this market between the bid and the offer is approximately $1. Okay, 90 cents, $1, which certainly seems pretty cheap, right? To have some really nice upside exposure for $1. Well, that's one of the nuances of a butterfly. Okay, our butterfly spreads are typically, and I'm going to put in quotes here, cheap. What does cheap mean? What does cheap really mean? Well, how do we measure expensive or cheap? Well, we have to measure that really by the reward to risk. Okay, exactly. The reward to risk. Okay, so when I say this is cheap, if we can buy this spread for $1, okay, what is the maximum value of this particular butterfly? The 1200, 1220, 1240. What is the maximum? Well, the maximum any spread can be worth, any vertical spread, meaning where the strikes are within the same expiration, so not a calendar or anything like that. Right, the maximum value is $20. Okay? It's $20 because if the stock went to the short strike, at expiration, our 1200, 1220 call spread will be worth 20, where the short spread that we used to finance the purchase of the long spread is going to be worth 0. So the maximum value is 20. So that means from expensive or cheap, our reward to risk is 19 over 1 or 19 to 1. Does everybody see how that is 19 to 1? Because if it is worth $20 at expiration, we can make 19. All we can ever lose here, all we can ever lose is the investment we put into this of $1. So even if the stock were to go to 0 or the stock were to go to 10,000, all we could lose is $1. And likewise, regardless of where the stock goes, this can never be worth more than $20. So when we typically look at reward to risks on different types of spreads that we're trading, we've discussed this before, we're sometimes looking for 2.5, 3 to 1, maybe a little bit more than that. But you can see here on a butterfly, you're getting a massive amount of bang for your buck. So what does that tell us? Right? If we put on a position that has this massive, massive potential, what is that telling us? Well, it tells us that the probabilities of that happening are pretty low, which is why I said at the beginning of this conversation, this is kind of like hitting the bullseye or kind of like pinning the tail on the donkey. Okay, and that's the way that butterfly spreads work. And that's a reason why traders love butterflies, because they're typically very, very cheap. They provide huge reward to risk, but they don't always come into play at that size maximum gain. Now let's go through what the P&Ls would be on something like this here. Breaking this down, it means we bought the 1200 call and sold the 1220 call. That's the first part of our butterfly. The second part is sold the 1220 call and bought the 1240. The reason why we buy that last strike, okay, the end of the butterfly, is for protection. Okay, it gives us our maximum risk, and we always want to know our maximum risk going into any position. What would happen if we just bought the 1200, sold 2 of the 1220s, and never bought that last strike, that 1240 call? What would happen there? Well, in this case, if Tesla really, really flew, okay, really just exploded beyond all our strikes, we have unlimited loss. We have unlimited loss because we're short one option, short one call if we didn't buy that 1240 call. Remember, a butterfly is always done in a 1 to 2 to 1 ratio. And that's so we have an even number of long options that we bought, and an even number of short options that we have sold. This way we can always identify what our maximum exposure is. Okay, so let's go through a couple scenarios. What happens at expiration if the stock is, okay, and I'm going to put a couple scenarios here. Okay, anywhere below 1200, what would happen to the value of this butterfly at expiration? It'd be worth 0. That's because all of the options would be worth 0. Okay, so again, our maximum exposure, our maximum risk is the $1 that we paid for this. Okay, what if we're at 1205? This is just going to equal $5. Our long part of the butterfly, the 1200 1220 spread, is worth $5. The short 1220 1240 is worth 0, so this would be 5. okay, for a profit of $4. Remember, we've paid $1 for this. What we're looking at right here is just the value of the butterfly. Okay, so the math is pretty simple. Let's say we're at $12.11 at expiration. The value of this is going to be $11. If we're at $12.18 at expiration, the value of this is going to be $18. And then obviously, as we spoke about just a few minutes ago, at $12.20, the short strike, the maximum value is going to be $20. So what happens if we start going past the short strike? And that's where a lot of traders get, I guess I'll use the term freaked out. Okay? They start getting really nervous because all of a sudden they have a short option that's in the money. And they get really concerned that, oh no, what happens if I get assigned? Okay, so let's take a look at this. Okay, what happens if at expiration the short option is in the money? Meaning, what happens at 12.22, let's say? Okay, what would the value at 12.22 be? Well, the long option would be worth 22. The short options would be worth $2 each, for a total value of $18. And so on and so forth. Let's go up to 12.31. Okay, at 12.31, the long option would be 31. The shorts would be 11 each. So that equals, $9, not $10. That equals $9. 31 on the long, each short worth 11. 31 minus 22 is worth $9. And as we get closer and closer and closer to the end of the butterfly strikes, the 12.40 in this instance, the value of this position is going to keep decreasing. Okay, so at 12.38, we have $38. The shorts are worth 18 each for a value of $2. And then at 12.40, okay, the magic of 12.40 being the upper end, the long is going to be worth 40. The shorts are worth $20 each. So the overall value is 0. What happens then at any price over the top strike at expiration, the value is going to be 0. And that's where the beauty of a butterfly comes in, that when you do it in this ratio 1 to 2 to 1, and the options are symmetrically placed like they are, you can never, ever lose more than your investment. The value of the spread, the value of the butterfly, okay, can never be worth less than 0. And so let's just randomly pick a number of 1,300 at expiration. Okay, your long would be worth 100. The shorts, they'd be worth $80 each. But then we have that other long option. Remember at the end, the last wing. Okay, so that 12.40 call would be worth $60. If I add that all up, that's plus 160 minus 160, still for a price of 0. So butterfly positions, they can be very speculative, but speculative because hitting the nail on the head, hitting the bullseye, typically doesn't happen. But the reward to risk is phenomenal. That's why butterflies are very, very inexpensive ways to play a position, a directional position. The key is, number one, the options have to be in a 1 to 2 to 1 ratio. You can do it 5 to 10 to 5, 100 to 200 to 100, but you have to have the same amount of long options as you do short options. And the width between the strikes have to be symmetrical. You can choose whatever expiration you want. The further out in time you go, a little bit more costly these butterflies will be, just like any position. Typically, when you buy more time, the positions will cost a little bit more. The closer in to expiration, the lower that reward to risk is going to be. The further you go out, the higher that reward to risk is going to be. But again, the key is we are always 100% risk defined. Always 100% risk defined. All right, everybody. So that's some of the beginning characteristics, if you will, of a butterfly spread. Why we would do it. What the reward to risk is. Okay. You can do it when you're bullish. You can do it when you're bearish. It is always completely risk defined when you set it up right. So that was the butterfly spread. We're going to continue on with the next video into what a broken wing butterfly spread is. But for right now, really appreciate you listening in. Remember to like, comment, and subscribe. Thanks, everybody.